The reason Rockefeller became the wealthiest person in recorded history was not genius. It was not ruthlessness. It was not the era, the industry, or the accident of being in the right place when oil was discovered beneath Pennsylvania. Other men were in the same place. They had the same crew, the same geography, the same historical moment. They did not build what he built. The difference was not talent. It was not luck. It was 5 rules, identified early, applied without exception, maintained without revision for 60 years. Rules that the financial system has always rewarded. Rules that were true before he followed them, remained true while he followed them, and remain true now that he is gone. The rules do not belong to the 19th century. They do not belong to the oil industry. They belong to the structure of capital itself, and that structure has not changed because it cannot change. It is not a policy. It is not a trend. It is arithmetic. You have read enough finance books to feel informed. You follow the right accounts. You understand the concepts. And you have not yet built anything. Not because the information was wrong, but because information was never the missing variable. The structure was, there is a ledger. It has 5 entries. They were written once, and they have never been revised because the laws they record do not require revision. What follows is not history. It is not a profile of a man who lived a century ago. It is the ledger, still open, still accurate, still waiting. There is a specific position that produces a specific kind of frustration. You are informed. Genuinely. You have read the books that matter, not the surface-level ones, the ones that require something from you. You understand compound interest not as a slogan but as a mechanism. You know the arguments for index funds, for early accumulation, for the structural advantages of ownership over labor. The conceptual framework is present. It is real, and nothing has been built from it. This is not an intelligence failure. The information was correctly received. The concepts were correctly understood. The failure is not at the level of comprehension. It is at the level of structure. There is a gap between understanding how capital works and operating inside the conditions that capital rewards. That gap is not closed by more information. It is closed by identifying the specific laws that govern the mechanism and following them without exception in sequence, without modification based on circumstance or feeling. Rockefeller did not read about capital. He did not follow commentators who explained it. He identified the laws that governed it. Through observation, through his ledger, through the methodical examination of what the system consistently rewarded and what it consistently punished. And he applied those laws to every decision he made from the age of 16 until his death at 97. The laws were not secrets. They were available to every man in his industry. Most of those men did not apply them, not because they lacked intelligence, but because the laws require something that information alone does not supply. Structural commitment to a set of operating principles that do not bend under the pressure of short-term conditions. Opening the ledger is not the same as reading it. Reading it is not the same as understanding it. Understanding it is not the same as operating inside it. What follows is the ledger. 5 entries. The structure beneath the structure you already know. The ledger has a cover. Before the first entry is written, there is a page that states the ledger's governing principle, the law without which none of the others can operate. It reads, accumulation precedes deployment. This is the first law. Not a suggestion about saving before spending. That is the surface reading. And the surface reading is insufficient. The first law is a structural statement about the sequence in which capital must move before the financial system's rewards become available. The mechanism requires a specific order of operations. Capital must first be accumulated, extracted from income, protected from consumption, held in sufficient quantity to cross the threshold at which deployment becomes structurally viable. Only then can it be deployed into positions that generate return. Only then can those returns compound. Only then does the geometry of wealth accumulation engage. Most people reverse this sequence. Not from laziness, from a misunderstanding of where the mechanism begins. They deploy before they have accumulated sufficiently. They invest small amounts spread across multiple instruments before any single position has reached the threshold at which it generates structurally meaningful return. They respond to every new opportunity before the capital required to enter that opportunity correctly has been assembled. The result is perpetual motion with no accumulation. Rockefeller's first act, before any investment, before any business decision, before any deployment of capital, was accumulation. His personal ledger, begun at 16, tracked every dollar entering and exiting his position, not to manage spending but to ensure that the accumulation line was always ahead of the deployment line. Capital was not deployed until it had been accumulated to the level at which the deployment could perform its function at the required scale. He described this as the discipline of the full barrel. A half-filled barrel of oil cannot be refined efficiently. The processing cost per unit rises as volume falls, until below a certain threshold the operation generates loss rather than surplus. The accumulation phase is the filling of the barrel. Deployment begins when the barrel is full. The first law has a specific implication for the person who has read the books and followed the accounts and understood the concepts without yet building anything. The sequence has been wrong. Not the information, not the instruments, not the intent. The sequence. Deployment decisions have been made before the accumulation threshold that makes those deployments structurally viable has been reached. The positions entered have been real but insufficient in scale to generate the compounding return that makes the mechanism visible and self-reinforcing. The ledger does not record investment vehicles. It records position size relative to threshold. Below the threshold, the minimum accumulation required for deployment to produce structurally meaningful return. There is no first law violation visible in the account statement. The investments exist. The positions are real. The returns are mathematically present, but they are too small relative to the ongoing income and expenditure of the financial life around them to change the structure of the position. The tail does not wag the dog. The returns are a rounding error on a life still governed entirely by the labor income that funds it. The first law is not violated by investing small amounts. It is violated by treating small investments as if they constitute the deployment phase, as if the sequence has been completed, when the accumulation required for deployment to function at the required scale has not yet been assembled. Rockefeller's ledger was unambiguous about this. Capital below the deployment threshold is accumulation in progress. It is not yet in the ledger. The ledger's second entry is shorter than the first. It does not require extensive explanation. It requires only that the mechanism it describes be understood precisely, because it is the entry most often read correctly and applied incorrectly. It reads, "Own the mechanism, not the output." This is the second law. And it is the structural principle that separates every accumulation of durable wealth from every accumulation of income. Output is what a mechanism produces. Wages are output. Dividends, before ownership is established, are output. The return on a position you do not control is output. Output is valuable. Output pays the bills. Output is the thing most people spend their entire financial lives pursuing, maximizing it, protecting it, worrying about its continuity. The mechanism is what produces the output. Ownership of the mechanism means that the output flows to you not because you are present and working, but because you hold the structural position that entitles you to it. The mechanism runs. The output moves through the pipeline. It arrives at your position because your position is ownership, not labor. Rockefeller did not want to be paid for his work. He wanted to own what did the work. This is not a subtle distinction. It is the structural difference between an income and a capital position. An income requires your continued presence and effort. A capital position requires your continued ownership. Presence and effort are finite, bounded by time, by physical capacity, by the limits of human attention. Ownership is not bounded by any of these things. The refinery runs whether Rockefeller is present or absent, awake or asleep, young or old. The second law has an implication for the person who has built a career, accumulated expertise, and developed a real market value for their labor, and has directed all of that value toward maximizing the output of the labor rather than acquiring ownership of mechanisms. The career is the output. The financial position that the career has produced is output held in storage. Neither is a mechanism. The transition required by the second law is not the abandonment of the career. It is the systematic redirection of a portion of the output, consistently, sequentially over time, into positions that constitute ownership of mechanisms. Equity in enterprises. Ownership stakes in assets that generate return. Positions that produce output independent of your presence. The ledger records this transition not as a single event but as a ratio, the proportion of your capital position that is output versus the proportion that is mechanism ownership. That ratio changes over time as the second law is applied. The target is not a specific number. It is a direction. Consistently, the ratio moves toward mechanism ownership. Consistently, the output of labor is converted into the ownership of what produces output. At Rockefeller's peak, his labor was irrelevant to his capital position. Standard Oil ran without him in any operational sense. His ownership was the mechanism. The output was a consequence of the ownership, not of his presence. That is the end state of the second law applied across a financial life. The second entry in the ledger closes with a single line. The man who owns the refinery does not need to operate it. The ledger's third entry is the one most people have encountered in some form, and misunderstood in the same form. It has been simplified into a slogan, packaged into a motivational framework, repeated so many times in so many contexts, stripped of its mechanical precision, that the people who quote it most frequently are the ones least likely to be applying it correctly. The entry reads, "Compounding requires permanence, not patience." This is the third law. And the distinction between permanence and patience is the entire argument. Patience is a psychological disposition. It is the capacity to wait without acting, to tolerate discomfort without abandoning a position, to resist the pressure of short-term conditions. Patience is valuable. It is also insufficient. A patient investor who liquidates a position at the wrong moment, under the pressure of a market correction, an unexpected expense, a more attractive opportunity appearing elsewhere, has been patient and has still violated the third law. Permanence is a structural commitment. It is not a feeling or a disposition. It is the architectural decision to hold a position for a duration sufficient for the compounding mechanism to produce its geometric output, and to build the financial structure around that position in a way that eliminates the conditions under which premature liquidation would become necessary. The mechanism of compounding is not activated by patience. It is activated by permanence. The engine does not care how you feel about waiting. It responds to one variable: whether the position is maintained long enough for the geometry to separate from the line. Rockefeller understood this with a precision that the modern framing of patience entirely misses. He did not hold positions because he was comfortable waiting. He structured his financial life so that the conditions requiring liquidation, emergency cash needs, short-term obligations, the pressure of positions held on margin, did not arise. The permanence of his positions was not a product of his temperament. It was a product of his architecture. The architecture preceded the position. The reserve was established before the deployment. The obligations were structured so that no short-term condition could reach the long-term position and extract it prematurely. This is the structural reading of the third law that the patience framing obscures. Most people who fail to compound do not fail because they are impatient. They fail because they have not built the architecture that makes permanence structurally possible. The emergency that forces the liquidation of a long-term position is not bad luck. It is the consequence of deploying capital that should have remained in reserve, of entering the long-term position before the short-term financial structure was stable enough to leave it undisturbed. The position was entered. The position was real. The compounding began. And then the architecture failed. The reserve was insufficient. The obligation was unexpected. The pressure reached the long-term position and extracted it at precisely the wrong moment. The position was liquidated not at the point of geometric output but during the early period when the curve is still invisible, when the compounding has not yet separated from the line, when the returns are modest enough that the loss feels manageable. The geometry that was interrupted never restarts from the same point. It restarts from zero. The third law requires that the architecture be built before the position is entered, not simultaneously. Before. The reserve is established first. The short-term obligations are stabilized first. The conditions under which the long-term position would face pressure sufficient to force liquidation are identified and eliminated first. Only then is the position entered. Only then is permanence structurally possible rather than aspirationally intended. Rockefeller's ledger recorded the architecture alongside the position. Every entry noted not just what was deployed but what protected the deployment from the conditions that could interrupt it. The position and its protection were a single entry. Because a position without protection is not a permanent position, it is a temporary one that has not yet encountered the pressure that will end it. The third law closes with the mechanical statement that patience cannot provide. A compound position interrupted is not a compound position. It is a position that compounded briefly and then stopped. The ledger records the duration, not the intention. Permanence is not how long you intend to hold. It is how long the position actually runs. The ledger's fourth entry is the coldest one, not the most complex, not the most counterintuitive, the coldest, because it removes something the person reading it would prefer to keep. It removes the comfort of believing that good information, correctly applied, is sufficient to produce the outcome the first three laws are building toward. It is not sufficient. The fourth entry reads, "The cost of capital is not interest. It is optionality." This is the fourth law. And it requires that the concept of cost be understood at a level of precision that the standard financial framing does not supply. When capital is borrowed, the stated cost is the interest rate. This is the cost that appears in the contract, in the monthly statement, in the calculation that determines whether the deployment is worthwhile. The interest rate is real. It is also the smallest component of the actual cost. The actual cost of capital, whether borrowed or held in idle position or deployed in a low-return instrument, is the optionality that cost eliminates. Optionality is the structural capacity to act on an opportunity when it presents itself. It is not a feeling of freedom. It is the specific calculable property of the capital position that has not been committed, that remains available to be deployed into the highest value opportunity the environment presents at the moment that opportunity appears. Capital committed to a debt obligation has lost its optionality for the duration of the obligation. Every dollar servicing interest on consumer debt is a dollar that cannot be deployed into a position that generates return. The opportunity cost of that deployment is not the interest rate. It is the compounding return foregone on every dollar consumed by debt service across every year of the obligation's duration. Capital held in a low return position has lost a portion of its optionality to the differential between its current return and the return available in a correctly deployed position. The opportunity cost accumulates invisibly, compounding on the foregone base, producing the corrosion rate that idle capital generates without any transaction occurring. Rockefeller's relationship to optionality was structural and deliberate. He maintained capital in uncommitted positions specifically to preserve the capacity to act on opportunities that his competitors, whose capital was fully committed to existing obligations, could not access. When a competitor faced a liquidity crisis and needed to sell a refinery at distressed pricing, Rockefeller had the optionality to acquire it. Not because he had predicted the competitor's crisis, because he had maintained the uncommitted capital that made acquisition possible when the opportunity appeared. The fourth law does not argue against deployment. It argues for the deliberate maintenance of a portion of capital in uncommitted position, not as idle storage but as structural optionality. The reserve that the third law established to protect permanence serves a dual function. It protects existing positions from forced liquidation and preserves the capacity to act on conditions that reward capital availability. The person who has read this far and has no uncommitted capital, whose position is fully allocated to existing instruments, obligations, and deployments, has no optionality. They can observe opportunities, they cannot act on them. The observation without the capacity to act produces a specific and recognizable frustration. The awareness of what should be done without the structural position required to do it. This is not an information problem. It is a fourth law problem. The cost of the fully committed position is not visible in any statement. It does not appear as a line item. It appears only in the opportunities that pass without the capacity to enter them, in the distressed asset that could not be acquired, in the position that could not be entered at the moment of maximum structural advantage, in the decade that produced modest returns because the capital was correctly deployed but fully committed and therefore unable to respond to the conditions that reward uncommitted capital. Rockefeller's ledger recorded optionality as a position, not as cash sitting idle. As a structural asset, the capacity to act when the environment creates the conditions that reward action. That capacity has a value. The value is not calculable in advance. It is calculated in retrospect by the opportunities it enabled that fully committed capital would have foreclosed. The fourth law states the cost plainly. Fully committed capital is not fully deployed capital. It is capital that has traded its optionality for its current return, and the trade is permanent for the duration of the commitment. The ledger records what optionality costs when it is absent. It does not argue that the cost was avoidable. It records that the cost was real. The ledger's fifth entry is the last one. It is also the one that makes the previous four possible, because without it, the first four laws produce a structure that is technically correct and practically unstable, a structure that will be built and then dismantled, built again and dismantled again, not through failure of understanding, through failure of the one property that no financial law can supply from the outside. The fifth entry reads, the structure must be more durable than the conditions around it. This is the fifth law. And it is the entry that most directly addresses the gap between understanding the mechanism and sustaining the mechanism across the duration required for it to produce its output. Capital accumulation is not a project. It is not a plan with a timeline and a completion date. It is a structure, a set of operating principles applied consistently across decades, through conditions that will vary in ways no plan can anticipate, across periods when the structure feels correct and periods when every external signal suggests the structure should be abandoned. Most structures fail not because they were wrong. They fail because the conditions around them changed, and the structure was not built to be more durable than its conditions. The market corrected and the position was liquidated. The income declined and the accumulation sequence was suspended. The opportunity appeared and the optionality reserve was consumed. The obligation expanded and the long-term position was compromised. Each of these events is individually reasonable. Each of them applied to a structure that was not built for durability, ends the compounding that the structure was designed to produce. Rockefeller's structure survived conditions that destroyed his competitors not because the conditions did not reach him. They did. But because his structure had been built to operate through adverse conditions rather than in spite of them. The reserve was not sized for normal conditions. It was sized for the worst conditions his analysis suggested were structurally possible. The long-term positions were not entered at a scale that normal income could easily support. They were entered at a scale that reduced income could still support, so that an income reduction would not require position reduction. This is the structural thinking that the fifth law demands, not optimistic structural thinking, stress-tested structural thinking. The question is not what the structure produces under favorable conditions. That calculation is straightforward. The question is what the structure produces under the worst conditions that are structurally plausible, and whether those conditions can be weathered without abandoning the positions that the first four laws have established. Most people build their financial structure for normal conditions. Normal conditions are not the conditions that test a structure. The conditions that test a structure are the ones that arrive without announcement. The income disruption, the expense that cannot be deferred, the market environment that makes every position look like a mistake. These conditions do not arrive on a schedule. They do not provide the opportunity to restructure before they apply their pressure. They arrive and the structure either holds or it does not. The fifth law requires that the structure be built for these conditions before they arrive, not after. The reserve is sized for the adverse case. The obligations are structured to remain serviceable at reduced income. The long-term positions are sized so that no plausible short-term condition can reach them and force premature liquidation. This is not pessimism. It is the structural prerequisite for permanence. The third law established that compounding requires permanence. The fifth law establishes how permanence is made structurally reliable rather than aspirationally intended. The two laws are not separate entries in the ledger. They are the same entry read from opposite directions. The third law reads forward. Permanence is required for compounding to produce its output. The fifth law reads backward. Durability is required for permanence to be structurally possible rather than merely desired. Rockefeller built structures that outlasted him. Not because he was unusually fortunate in the conditions he encountered. He was not. He encountered price collapses, regulatory challenges, competitive attacks, and economic contractions that destroyed companies larger and better capitalized than his own. His structure survived these conditions because they had been designed for them. The fifth law closes the ledger with the only question that matters after the first four entries have been understood and applied. Not, is the structure producing the expected return under current conditions? But is the structure capable of maintaining its positions through the conditions that current conditions will eventually become? If the answer is yes, the ledger entry stands. If the answer is no, the structure requires revision before the conditions that will test it arrive. The ledger records the structure, not the conditions. 5 laws. 5 entries in a ledger that was written once and has not been revised. Because the laws it records are not a response to any particular economic environment. They are a response to the permanent structure of capital itself. The way capital accumulates, the way compounding operates, the way optionality is created and destroyed, the way structures fail when built for normal conditions and survive when built for adverse ones. These laws were available before Rockefeller applied them. They were available to every man who competed with him in the oil industry. Men with equal access to the same crude, the same geography, the same historical moment. Those men did not apply the laws, not because the laws were hidden, because the laws require something that information alone does not supply and that optimism actively undermines: the structural commitment to operate inside a set of permanent principles regardless of what conditions suggest in any given period. The information was never the missing variable. You already knew most of this in some form. You understood compound interest. You had read the arguments for ownership over labor, for long-term positioning, for the maintenance of reserve capital. The conceptual framework was present and real. What was absent was the ledger. Not the concepts. The ledger, the permanent record of operating principles that governs every capital decision, not because the conditions favor it, but because the laws themselves are structural constants, because the system has always rewarded these behaviors and has always punished their absence. Because the arithmetic that produces Rockefeller's outcome from these 5 inputs is the same arithmetic that produces a structurally sound financial position from the same 5 inputs at any scale, in any era, under any conditions that are not the complete collapse of the economic system in which capital operates. The immutable ledger is not a historical document. It is an operational one. It is not describing what Rockefeller did. It is describing what the system rewards, and has always rewarded, regardless of who is doing it. The 5 laws are the structural constants. They do not shift with the market. They do not update with the economy. They were not invented by the era that produced Rockefeller, and they were not buried with him. They are the permanent architecture of capital accumulation, visible to anyone who examines the mechanism with sufficient precision, available to anyone willing to operate inside them with sufficient consistency. The ledger has been open the entire time. The ledger is complete. 5 entries. 1 governing principle per entry. Each one mechanically precise, structurally sound, and this is the part that requires a moment to sit with. Entirely available to you before today. Not hidden. Not restricted. Not requiring access, credential, or historical circumstance that you do not possess. Available. Written in the behavior of every capital structure that has produced durable accumulation across every economic era in which such structures have been studied. Legible in the outcomes of the people who have followed these laws and in the failure modes of the people who have not. You have read this ledger. You understand what it records. What it does not record is intention. What it does not reward is comprehension. The ledger is indifferent to how clearly the laws have been understood. It records only whether the structure reflects them, whether the accumulation sequence precedes the deployment, whether the position is in mechanisms rather than output, whether the architecture supports permanence rather than aspirational patience, whether optionality has been preserved as a structural asset, whether the structure has been built for the conditions that will test it rather than the conditions that currently surround it. The ledger records what the structure is, not what you intend the structure to become. If the structure does not yet reflect the 5 entries, the ledger is still open. It does not close on a schedule. It does not have a deadline by which the entries must be made. But the arithmetic that the entries produce, the compounding that permanence enables, the optionality that uncommitted capital preserves, the durability that stress-tested structure provides, begins only from the moment the entries are correctly made. Every year the entries remain missing is a year the mechanism did not run. The arithmetic of those years does not recover. It simply does not appear in the ledger. The ledger has been open your entire life. It is still open.